A young couple gets the call they've been waiting weeks for. Instead, they hear this: "Unfortunately, we can't approve your mortgage." They're stunned. Excellent credit, 20% down, stable jobs, everything the bank said they wanted. So what happened? The loan officer explains. "It's not you, it's the HOA. The HOA doesn't meet our lending requirements." If you're buying or already own in a community with an HOA, moments like this can blindside you. Subscribe to Community Living for practical HOA education, no drama, so you're never the one caught off guard. Buying into an HOA isn't just buying a house. You're buying into shared finances, shared legal liability, shared insurance, shared governance. Every owner in that community is financially tied to every other owner. Banks know this. That's why, when you apply for a mortgage in an HOA, the lender isn't just evaluating you, they're evaluating the association itself, its finances, its risk, its stability. That surprises almost everyone applying for their first HOA mortgage. Picture an underwriter working through a checklist before your loan can close. Too many owners behind on their dues. Too little money in the reserve fund. Pending lawsuits against the association. Gaps in the community's insurance coverage. Too high a percentage of renters compared to owners. Any one of these can stall or kill a loan. And here's the part almost no one expects. None of it has anything to do with your credit score. A buyer does everything right. Strong income, clean credit history, a solid offer. Then the underwriter pulls the HOA's numbers. 28% of owners in the community are behind on their dues. Loan denied. Not because of the buyer, because of the neighbors. Another buyer is weeks from closing. Then the lender discovers the HOA is being sued. Financing gets paused while the litigation plays out. The seller isn't willing to wait. The buyer loses the contract over a lawsuit they never even knew existed. A third buyer's HOA skipped its reserve study for years. Underfunded reserves eventually catch up, and a massive special assessment lands on every owner at once. Once lenders see it, the loan terms change. The buyer walks away. Why does any of this matter to a bank that isn't lending to the HOA? Just to you. Because an unstable HOA puts everyone's investment at risk. If dues go unpaid, maintenance gets deferred. If maintenance gets deferred, property values fall. If insurance becomes harder to get, the whole community becomes harder to finance. One shaky HOA can lower the value of every home inside it, including the one the bank is about to lend on. Banks don't just hate risk in a borrower, they hate risk in the collateral. And your home is the collateral. So what can you actually do before you make an offer? Ask for the reserve study, the budget, the financial statements. Ask for a certificate of insurance. Ask whether there's pending litigation. Ask about owner occupancy rates and the current delinquency rate. If any of this sounds familiar, it should. We covered exactly what to request in an earlier video, Before You Buy. 10 HOA financial documents to review. That video told you what to ask for. This one tells you why your lender cares about the answers just as much as you should. In the end, a mortgage denial rarely comes down to one single thing. It comes down to how healthy the community you're buying into really is. Sometimes it isn't your credit score standing between you and your dream home. It's your neighbors. If this helped, you understand what your lender already knows. Subscribe to Community Living for practical HOA education. No drama. And check out Before You Buy, 10 HOA financial documents to review for exactly what to ask before you make an offer. Thanks for watching. We'll see you in the next one.